Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode?
Going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time.
Hi everyone. Welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence.
The Federal Reserve has been quite aggressive in its fight against inflation. Officials approved 11 rate hikes during the 12 meetings between March 2022 and July 2023, raising the benchmark federal funds rate at its fastest pace since the early 1980s. But the abrupt change in monetary policy made investors nervous, as over-tightening could easily bring about a recession. That fear sent the S&P 500 tumbling into a bear market early last year. However, investor sentiment has improved greatly in recent months amid signs of economic resilience. Inflation fell to 3.0% in June, closing in on the Fed's 2% target, and U.S. GDP growth accelerated in the first and second quarters. That positive data helped the S&P 500 rebound sharply from its bear market lows, and the broad-based index is now less than 5% away from a fresh all-time high. Reaching that mark would definitely signal a new bull market. But history says the S&P 500 is headed even higher in the next year. Chairman Jerome Powell says the Fed will assess the need for further credit tightening on a meeting-by-meeting basis, but most investors believe the rate hikes have ended. Derivatives markets currently reflect an 80% chance that rates remain unchanged at the September meeting and a 25% chance that rate cuts occur by January 2024. If you are enjoying this video, we really appreciate it if you can please hit that like button so others can find this video as well, and make sure to subscribe to receive next videos. So what? The S&P 500 tends to rise sharply once the federal funds rate settles. Indeed, the Fed has spearheaded 6 other rate hike campaigns since 1988, and the S&P 500 returned an average of 23.7% during the one-year period immediately following the last rate hike in each campaign. In other words, if the current rate hike cycle has ended, history says the stock market could climb much higher in the next 12 months. Investors looking to take on less risk should consider an S&P 500 index fund like the Vanguard S&P 500 ETF. It tracks hundreds of large-cap U.S. stocks from all 11 market sectors, allowing investors to spread capital across many of the most influential businesses in the world. That diversity makes the Vanguard S&P 500 ETF a safer investment than most individual stocks. Indeed, Warren Buffett has often recommended an S&P 500 index fund because the index itself is a cross-section of businesses that in aggregate are bound to do well. Whether the S&P 500 is up or down in any given year is a coin toss, but the odds of a positive return increase as the holding period lengthens. The S&P 500 has been a profitable investment over every rolling 20-year period since its inception in 1957, and its precursor was a profitable investment over every rolling 20-year period since its inception in 1926.
For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive more videos on memos and write-ups from top investors. Thanks for watching.